A smaller group quietly does something very different. They make money work for them. Not with wild trades, not with secret hedge fund tricks, but with something boring, invisible, and insanely powerful: cumulative return. Today on our channel, we're breaking down how small, consistent investments turn into real wealth over time, and why the secret isn't being a genius. It's understanding compounding, staying put, and letting time do the heavy lifting. So what is cumulative return? In plain English terms, let's keep it simple. Cumulative return is the total growth of an investment over time, which includes the profit you make and the profit your profits make when you reinvest them. It's not just I made 6% this year, it's what happened when I left that money alone for 5, 10, or 20 years and all the gains kept compounding on top of each other. Think of it like planting a tree. Year 1, you get a small tree. Year 5, that tree drops seeds. Now you've got more trees. Year 15, those trees drop seeds. At some point, you're not planting anymore. The system is doing the work. That's cumulative return, and it's how ordinary people on normal incomes quietly build serious wealth. Why does a cumulative return beat quick wins? Here's the key idea. It's not the size of your win, it's the consistency of your returns. Let's take one example. Let's say you invest $10,000 at 6% per year for 10 years, and you reinvest everything. Using compounding, that becomes about $17,900, a gain of 79%. If you didn't reinvest, if you just took the 6% out every year, you'd end up with only $16,000. Same rate, same time, different behavior. That extra money didn't come from working harder, it came from your returns earning additional returns. Cumulative return is literally your money hiring more money to work for you. Time is basically your unfair advantage. The most powerful variable in this entire story isn't luck, it's time. Imagine two people, Investor A and Investor B. Investor A starts at 25, investing regularly at 6% per year. Investor B starts at 35, investing the same total amount at the same 6%. By 65, Investor A has nearly double the wealth of Investor B, but not because they earned a better return, but because they started earlier. That's the magic. The earlier you start, the more your past gains show up as new workers in the system. Most people massively underestimate this. Psychologists call it exponential growth bias. Our brains are terrible at feeling how fast compounding accelerates over time. We get excited by I doubled my money on this trade, but we do ignore I 7x'd my wealth slowly by doing nothing fancy for 25 years, which by the way is exactly what long-term index investors have been doing. Real-world proof, S&P 500 example. Let's put numbers on it. If you had invested $100 into the S&P 500 at the start of 2000 and simply reinvested your dividends, by 2025 that would be worth around $712.59. That's a 612% return. No day trading, no meme stocks, no magic timing. You didn't need to be brilliant, you just needed time, a diversified asset, and the discipline to leave it alone. That's cumulative return in the wild. It's boring, it's relentless, it is unmatched. Now, how do we sabotage ourselves? If cumulative return is so powerful, why doesn't everyone benefit? Simply, it's because our emotions keep getting in the way. We pull money out when markets fall. We chase hot tips instead of long-term plans. We treat dividends and interest like spending money instead of fuel. Now, every time you panic sell, you stop reinvesting, or you sit in cash waiting for the right moment, you're unplugging the compounding engine. Legendary investors like Warren Buffett didn't get rich because of one genius trade. Buffett's superpower is decades of compounding at steady rates. He let time do what short-term traders don't have the patience for. Now, how do you make cumulative return work for you? So how do you actually use this in your own life? First, start early, even if it's small. 20, 50, 100 euros a month. It's not about how impressive it looks today, it's about what it's going to become. Number 2, reinvest everything. Dividends, interest, gains. Don't treat them as a bonus paycheck, treat them as new employees. Dividend reinvestment alone has historically been responsible for a huge portion of total market returns. Many S&P 500 analyses show 40+% of long-term gains come from reinvested dividends. Number 3, stay diversified. And stayed fully invested, your annualized return would have been around 10.5%. Miss just the 10 best days, that drops to about 6.2%. Timing the market is how you break compounding. Number 4, use compound-friendly tools. Low-cost index funds, ETFs, retirement accounts, DRIPs, which are dividend reinvestment plans. 2 savers. Saver A, 10,000 euros at 1% in a savings account, 12,000 euros after 20 years. Saver B, 10,000 euros at 6% in a diversified ETF, 32,000 euros after 20 years. Same effort, different understanding. Now let's talk about the mindset shift. Here's the real takeaway. Cumulative return isn't just a formula, it is a mindset. It says, be patient, be consistent, don't interrupt the process. Think long-term, not short-term. Your money is an employee. If you fire it every time markets wobble, it never gets promoted. If you let it work for decades, it will out-earn you. True wealth rarely comes from frantic efforts. It comes from quiet compounding over time. Now, if this helped you see investing differently, don't just click away and forget it. Set up that automatic investment. Turn on dividend reinvestment. Let time do what timing never will. And drop a like as well. This is BridgesTV, where we break down the systems that move money, markets, and your financial future. We'll be very happy if you hit like, subscribe, and share this with someone who still thinks saving is enough. Let your money start working the night shift for you.